55% of self-employed people have zero retirement savings. That number isn't bad luck. It's not poor discipline. It's not because self-employed people are bad with money. It's because the system was never built for you. And I don't mean that metaphorically. I mean it was times literally, structurally, architecturally, times designed around one type of worker, the employee. The person who shows up, clocks in, and has an employer quietly doing half the heavy lifting in the background. Every retirement framework in the US, Canada, the UK, and Australia built for that person, not you. And here's what makes this genuinely infuriating. It's not that the tools don't exist for self-employed people to retire well. They do. Some of them are actually more times powerful than anything a W-2 employee can access. But the system makes them harder to find, harder to use, and almost impossible to figure out without someone sitting you down and walking you through exactly what you're missing. That's what this video is. But before I show you the accounts and the strategies, you need to understand what's actually being taken from you. Because most self-employed people I talk to, freelancers, consultants, contractors, sole traders, they have a vague sense that they're behind on retirement. They just don't know times how far times behind or times why. And once I show you the real numbers, you'll never look at your tax bill the same way again. Let me start with the most expensive thing you never see. When you work for an employer, they pay half your Social Security and Medicare tax. In the US, that's 65% of your salary gone before you ever touch it. You don't see it on your paycheck. You don't feel it. It just disappears on your behalf. When you're self-employed, you pay both sides, the full 15.3%. Every dollar you earn, the government takes 15 cents before you've even started thinking about income tax. Before rent, before food, before retirement. That's the self-employment tax. And it's the first structural penalty you absorb just for choosing to work for yourself. Same thing in Canada. Employees split CPP contributions with their employer. If you're self-employed, you pay the employee times and times the employer portion, both sides, straight out of your pocket. In Australia, employers are legally required to deposit 11% of their employees' salaries directly into superannuation. That's the superannuation guarantee. For self-employed Australians, it's voluntary. Nobody does it for you. Nobody reminds you. And only 34% of self-employed Australians are making regular super contributions at all. In the UK, employed workers get auto-enrolled into a workplace pension with a mandatory minimum 3% employer contribution on top of their salary. Self-employed, you were quietly excluded from auto-enrollment entirely. That's not a coincidence. That's a pattern. Now, here's where I want you to stop for a second and actually do this in real time. Comment below just your country and a Y or N. Are you making consistent monthly contributions to a retirement account right now? Not, I put something in last year. Consistent, monthly, Y or N. Because I already know what most of you are going to type. And it's not because you're irresponsible. It's because nobody designed this system to make it easy for you. Nobody auto-enrolled you. Nobody matched your contributions. Nobody reminded you at tax time that you could have sheltered $40,000 last year and didn't. And that brings me to the number that I think will genuinely make you angry. The average employer 401k match in the United States is 4.7% of salary. On a $90,000 income, that's $4,230 a year in free money times that a W-2 worker receives automatically. You receive zero. Now compound that over 25 years at a 7% average annual return, which is conservative by historical standards, and that employer match alone, money that was never available to you, compounds into $284,000. That's not your savings, that's the times gap. That's the extra $250,000 that the employed person built without lifting a finger, simply because of how they get paid. And that gap gets worse every year you don't close it. But here's where the whole story flips. And this is the part that most people never get to, which is exactly why I need you to stay with me for the next few minutes. Because buried inside the same tax code that punishes you, there are retirement accounts specifically designed for the self-employed that are, and I mean this, more powerful times than anything available to a regular employee. The contribution limits are higher, the tax advantages are real, and almost nobody uses them correctly. The problem isn't that the tools don't exist. The problem is that they're explained badly, set up wrong, or never mentioned at all. There are essentially 5 accounts you need to know about. I'm going to move fast, so stay with me. First, the traditional or Roth IRA. $7,000 a year if you're under 50, $8,000 if you're over. This is the floor. This is where you start if you haven't started anywhere, but this alone won't close the gap. This is the warm-up. Second, the SEP IRA. Now it gets interesting. As a self-employed person, you can contribute up to 25% of your net self-employment income, capped at $69,000 in 2024. One account, no employees required, and every dollar you put in is tax deductible. If you're making $150,000 net, you can shelter $37,500, wiping out the tax liability on that entire chunk of income. Most self-employed people have never been told this exists. Third, and this is the one that changes everything, the solo 401 cuck. If you have no full-time employees other than yourself or a spouse, you qualify, and the structure is remarkable. You contribute as both times the employee and the employer. Up to $23,000 on the employee side in 2024, plus a $7,500 catch-up if you're over 50. Then, up to 25% of net self-employment income on top of that as the employer contribution. Total combined limit, $69,000 a year. Potentially $76,500 with catch-up contributions. That is more than triple what a standard employee can contribute to a 401 KEC with no employer match. Triple on the same income. And here's the thing most people miss about the solo 401k. You can choose a Roth version, which means the money grows completely tax-free. Or you can take the traditional deduction now and reduce your taxable income this year. Or you can do both, splitting contributions strategically based on where you expect tax rates to go. An employee doesn't get to make that choice. You do. Fourth, the simple IRA and the defined benefit plan, which are relevant once you're earning consistently above $200,000 and want to shelter even more. A defined benefit plan can allow contributions well above $69,000 annually, depending on your age and income. This is the account that high-earning self-employed professionals use to legally reduce their taxable income by 6 figures. I'll cover this in depth in a separate video because it requires its own breakdown, but I want you to know it exists. And fifth, for my UK audience, the self-invested personal pension, the SIPP, you can contribute up to 100% of your annual earnings or £60,000, whichever is lower, and receive tax relief at your marginal rate. If you're a higher rate taxpayer in the UK, that means for every £80 you put into a SIPP, the government adds £20 automatically. And if you claim through self-assessment, you can claim back another £20 on top of that. Effectively, £100 in your pension costs you £60. Most self-employed people in the UK are not doing this. Now, and this is critical, knowing these accounts exist is step 1. But there's a sequence to this that most people get completely wrong. And getting the sequence wrong doesn't just mean you miss out on some savings. It can mean you contribute to the wrong account, hit the wrong limits, lose the deduction, or in the worst case, trigger a penalty that wipes out the benefit entirely. Quick question. If I asked you right now which of these accounts you currently have open and whether you're maximizing it correctly, could you answer that with confidence? Comment yes or no, because if the answer is no, that's not a personal failure. That's the system working exactly as designed, complicated enough to discourage you, obscure enough that most accountants don't proactively bring it up, and just inaccessible enough that you keep putting off dealing with it. But here's what I want you to take away from this video right now, before you do anything else. The retirement gap between self-employed people and employees is not primarily an income problem. Self-employed people oftentimes out-earn times their employed counterparts. The gap is a structural knowledge problem. The people who close it aren't necessarily making more money. They're using the right accounts in the right order with the right contribution strategy. That's it. You now know the accounts. You now know the limits. You now know exactly how much the structural disadvantage has been costing you, and more importantly, you know it's fixable. But there's a layer to this I haven't touched yet. And honestly, it's the layer that separates the self-employed people who actually retire comfortably from the ones who are still taking clients at 67 because they have no choice. It's not the account you choose. It's when you contribute, how you time it against your income, and how you coordinate retirement contributions with your quarterly estimated taxes so you're not robbing one to pay the other. Get that wrong, and you're technically saving for retirement while silently underfunding your tax payments, which creates a cash crisis that makes you stop contributing entirely. It's a trap, a very common, very avoidable trap, and I'm breaking down the exact contribution timing strategy in the next video, including the quarterly calendar I give to self-employed clients that shows them precisely when to fund accounts, when to hold cash, and how to stop retirement savings from collapsing under the weight of a tax bill they didn't plan for. If you've ever abandoned a retirement contribution mid-year because tax season blindsided you and you know who you are, that next video is specifically for you. Tag a self-employed person who needs to see this. Genuinely, you might just change their retirement. And if you're not subscribed, fix that now. This is a series, and each video builds on the last. You don't want to find video 3 without having seen video 2. The system wasn't built for you, but that doesn't mean you can't beat it. It just means you have to know the rules better than the people who wrote them, and that starts right here.